And while we wait for those earnings to come through, let's get to today's action. Joining us are Warren Pies from 314 Research and Emily Hill from Bowersock Capital Partners. She joins us on set. Emily, Warren, great to have you guys. Warren, I want to go to you first on this one. You think the market could still go below where we were in October. You're recommending 45% stocks, 30 to 40 bonds, I think, and 15% cash. Why is that where investors at home should be positioned?
Yeah, well, thank you for having me. That's our overall strategic asset allocation recommendations. It's basically underweight stocks and overweight cash and bills. And our thesis is, that at this point, 6 months post the October lows, if you're a bull here, you're basically arguing that we've seen the lows for this cycle. So we can look at the last 6 months and really triangulate. Does this look like a post-bottom environment? And I would say absolutely not. There are obviously some technical factors. We can get into that I think are keeping the market bid right here. But let's just take the big picture. What's going on with earnings? Basically, you should see earnings bottom 2 to 4 months after the market does and start stabilizing and heading higher. We haven't seen that this time. Earnings have ground lower across market caps, across sectors. There's absolutely zero angle you can take where you say earnings look like they've bottomed, forward earnings, that is, for the market. So to me, this does not look like a post-bottom environment, and earnings are square one there.
Emily, you're not bullish either. You have some specific names that you like, Lam Research, Corning, though admittedly they've run up quite a bit. Why do you like those kind of stocks?
Well, we're looking for value stocks that have a cash flow. So in the tech sector, I consider Corning somewhat tech adjacent or value tech. And so we're looking for parts of the market, and I do agree with Warren, by the way, we're looking for parts of the market that have not run up dramatically like you've seen with these large cap growth names and the big tech names that we're going to see reporting this week. I do think that I would be very surprised if the market has bottomed. So I'm not going to take the other side of this one.
So in light of that, I mean, is this a market that's not trading on fundamentals? And if so, what is buoying it right now?
Yeah, I think there are two things. Number one, there's still a huge amount of liquidity in the economy. So the money supply is about 40% higher than when it was in 2019. And so when you have that kind of liquidity sloshing around, money, there is an alternative now, where they're really in T-bills, whereas there wasn't, a year ago or so. But the second reason is I think one unappreciated factor is that retail investors are providing critical support for the market. So we saw $80 billion in retail money flow into the market in the first quarter. And the volume is actually pretty high. Prior to the pandemic, retail trading volumes made up about 12.5% of total volumes. Now it's closer to a quarter of market volumes. So that money, I think, has, a lot of these people have not experienced a really prolonged bear market like the one we saw in the financial crisis.
Yeah, I mean, and I get what you're both saying. But Warren, I mean, the S&P is up. It rallied to start the year, and we have had some very big moves in some individual stocks as well. Maybe the bottom, the floor is gonna fall out, and we're gonna see this drop in the major averages to test those October lows. But in the meantime, if you're not invested, you're missing out on this move, at least in the near term.
Well, yeah, I think that, and that's kind of a little bit of muscle memory from the last 10 years where we went through zero interest rate policy. And I would push back against that a little bit and say that cash is not trash any longer. And so if you're getting 5% almost in a money market fund, you have a pretty big hurdle rate. You have to have a pretty optimistic view of the market, of the equity market, I think, to push your chips back in the table. Now, and I would agree with the guest that there are technical factors that probably keep us bid here in the near term. Like we look at hedge fund and CTA positioning, and that's just really the fast money. In the stock market, by our measure, they're more short, hedge funds and CTAs, than really at any time that we have data back to, and that goes back to 2007. So huge short position. This puts a bid under the market. At the same time, vol's falling. As vol falls, systematic funds are able to increase. If they're targeting a certain realized vol percentage, they're able to increase exposure incrementally. So I think you have a lot of technical factors that keep a little bit of support in the market. So if you're going to be bearish, you got to look for catalysts.